And I saw all these huge inefficiencies which were choking me when I worked in the bank because it was stifling innovation to work in a bank. And then I saw this huge possibility that a smart contract can strip away 90% of middlemen or middlewomen or that middle layer, that marzipan layer of staff. And that's what really got me interested.
Hey there, good people in crypto land. I'm Matt Lysing, and this is my podcast, Decent People. Welcome back to the conversation. Today, I had a really interesting conversation with Haus, which is not his real name, but Huff is the co-founder of the Pear Protocol, which is a new decentralized exchange on Arbitrum that is seeking to put trading pairs together. Get it? Pair, P-E-A-R, and P-A-I-R. So you can put trading pairs together in a decentralized exchange fashion where you're going to go long on one digital asset and short on another. So you could be going long Ethereum and short Atom if you wanted to do that trade. That's using derivatives, and there's also leverage involved. And I was interested to learn that there isn't anything like this out there in the market yet, which this is a very common thing that you would find in traditional finance. That's where Huff came from. He spent 11 years at a large investment bank on the trading floor in equity derivatives and in volatility products like options. So he's bringing all that experience into the Web3 world. And we talked about how the differences are vast between, the Wall Street model of being cautious and not really trying to break the mold, and about how Web3 is all about bringing new people into the fold and offering these products and services to folks who wouldn't be able to get them in the traditional world through a bank. We also talked about how crypto trades on narratives and about how they are keeping a really close eye on regulation at Pear Protocol because, first of all, they're using derivatives, and second of all, there are issues around staking right now, where here in the US at least, the SEC seems to be thinking that staking and someone who stakes their coins and then earns an interest payment on that could qualify as a security, as a financial instrument. So that's a big feature of the Pear Protocol, which is based in the UK, and they are keeping an eye on that. And we also talked about anonymity in this world as well, and why Huff is choosing to have a pseudonym, which is an interesting sort of little facet I've always been intrigued by in the Web3 world. So with all that being said, let's get to the conversation. I hope you enjoy it. Thanks a lot for listening. Hey Huff, how you doing today?
I am fantastic. How are you, Matt?
I'm great. Thanks for coming on. And where am I speaking to you today from?
I am currently just outside of London.
Nice. Has spring sprung there, or how are things? How suicidal are you at this point?
It's springing. I think one of the nice things about being in crypto is you have plentiful opportunities to be part of the conference circuit. So looking forward to getting some more predictable weather this summer.
Yeah. Did you go to Miami?
I was on the verge of going to Miami, and then just a couple of in real life things popped up here, so I had to stay. I had an offer to join a panel, but didn't get to exercise it, unfortunately.
Oh, that's too bad. Miami is it's nice this time of year, as I'm sure. So, funny story. Huff is not your real name, and you were introduced to me as Huff House, which I learned today is a German conglomerate that makes modular housing. So it's literally a company. And I wasn't able to do any background on you, so I'm coming to this interview, except for what you're doing at Pear Protocol, which I understand. And that's PEAR for listeners, which I appreciate your wordsmithing there. It's a soon-to-be released protocol that will allow you to trade crypto pairs long short using leverage. But other than that, I don't really have much background on you. So I was wondering if you could just jump in and help, like, where are you coming from? What was the path that led you to Web3? And then maybe we could get into it from there.
Perfect. So probably slightly older than some people in Web3. So I graduated university in 2010, did an economics major, took a linear path into investment banking, joined the trading floor of a large investment bank, did that for the best part of just over a decade. And then in my early 30s, I rage quit my job. So having spent a decade on the trading floor, mostly in the kind of equity derivatives business, at two banks, I actually rage quit my job without much of a plan. And
Now, can we get some more detail? Like, tell us what was the rage quit? Like, how did it go down?
yeah, so traditional finance was just, and it still is at this juncture where a lot of the people that are working in it, their intention is to keep their job. It's not necessarily to innovate, it's to clip your coupons, if you will. And as a young man, I found that incredibly frustrating because I had a bunch of ideas, I had things that I wanted to do or see through, and there was always this resistance to doing anything bold in my space. I'll give you an idea. Like I said, oh, for this new product we're launching, perhaps we should create a video. And that video we can then show at client meetings. We don't need to take paper with us. It's much more environmentally friendly, and we can talk around the video after the pitch. And just got huge pushback on a long list of those kind of ideas. So one day I went in, it was after one of my birthdays, just after my 30th birthday. And I said, look, I don't really have a plan, but this isn't working for me. I don't want to do this for the next 10 years. And so I'd like to hand in my notice. And that was the end of that chapter.
Was there a precipitating event, or was it just like things had just cumulatively gotten so that you just had to get out?
I think it was definitely cumulative. I'd been feeling that way for a long time. So I'd seen the first wave of fintech startups come and go and didn't jump on board of that innovation. So if you cast your mind back to kind of 2015, 2016, I was maybe 5, 6 years into my career. You had businesses in the UK like Funding Circle coming up, these kind of fintech innovators who were trying to innovate payments and funding markets in a peer to peer kind of way. I had an opportunity to join a few of them and I turned it down. And so when this kind of DeFi movement started to gain traction, I'd learned my lesson at that point to really pay attention. And next time, the biggest risk was to take no risk, was my mindset. I didn't have a wife, I didn't have children. And so I decided to just free up my time and explore things that piqued my interest.
Had you been paying attention to Bitcoin or Ethereum at that point, or was this something that brought you to that?
I had, but more from a kind of speculative angle. So my story of how I got into crypto, and it's related to what I just described, but in 2015, 2016, when this fintech scene was burgeoning in London, I wanted to attend an event, and it was like a meetup event, just talking about fintech innovations in in global markets or in emerging markets or whatever. But to attend the event, you had to pay in Bitcoin. And this was 2016. I didn't have any Bitcoin. So I opened a Coinbase account. I bought like £100 worth of Bitcoin, which I think at the time got me like zero point 0.4 BTC or something. And I paid for the ticket in Bitcoin. I remember it was like the equivalent of £10 or £20 or something. And I left the residual Bitcoin in my Coinbase. And that's what really got me down the rabbit hole of crypto. So, from a speculative angle, then participated for the next few years, trading Bitcoin, Ethereum, and then a couple of the top 10 coins. Very much from like a trading perspective, which often ties into what I'm doing now. But it was only once I quit my job that I took the time to really delve into the technology and especially the ability to write smart contracts within DeFi. And that was a rabbit hole for me.
Isn't that funny that you're in London and you use Coinbase, which is obviously a US based exchange, but nothing, I guess it's just coming to mind is I don't think there was a London alternative, was there at that point? Or not, maybe not a well known one, or I just find that very curious.
Yeah, so Coinbase have done an incredible job of marketing themselves as like the safe harbor, if
Mhm.
you will, within crypto. And at the time, I just remember it was this like clean branding, very professional, FCA or FSA or whatever it was at the time, regulated. And so it just seemed like a natural fit. I think they'd done a little bit of a marketing push in the UK, and so they were on top of consciousness. I may have had a friend who had a Coinbase wallet. I really don't know, but there wasn't much thought that went into the decision. I just went to the most visible exchange, and at the time it was Coinbase.
Yeah. And then I've heard from a lot of people coming from the traditional financial world into this, into crypto, that, you know, in the early days, like then, 2016, if you were a currency trader, for example, like you could just waltz right over here into crypto and it's, oh my God, this is the best market ever because the spreads are huge and there's pretty good volatility. And it was a really, I think, easy fit for a lot of folks who maybe like yourself had been on the trading floor for a while. Did you find it in that way? I know you were doing equity derivatives, but it wasn't very foreign to you, I would guess.
It wasn't. So what then happened after I bought my Bitcoin, went to this event, and this event was obviously thought provoking because they were talking about Bitcoin as an alternative financial system, is I thought of Bitcoin like a commodity. And so I remember at the time being quite bearish on the markets. I don't know, something was going on that made you feel bearish. And I was buying gold. I was buying physical gold. So maybe, I don't know, just a small amount with each monthly paycheck. And I decided to divert a small amount to Bitcoin. So instead of spending, I don't know, a few £100 a month on gold, I'd half it and spend a few £100 a month on Bitcoin, a few £100 a month on gold. So I saw it very much like a commodity that you buy and hold. And then obviously it had this explosive price movement in kind of 2017. So a little bit of like fortunate timing.
Yeah, so you were getting in as like before it went up to 20,000 for the first time.
Yeah. So I like, everyone's got a bit of a sob story, but I'd acquired about at least 10 or 15 Bitcoin just by buying a small amount every month before things really took off. And when Bitcoin hit 5K, I basically sold everything but one. So I missed the move from 5K to 20K very begrudgingly.
That's okay. Pretty much everyone I've talked to on this podcast has that similar story. So you're in good company.
Yeah, I was applying everything the bank tells you, right? Like prudent risk management, take profit. This thing is a speculative asset. It's being used for money laundering. It's being used by drug cartels. It's being used for crime. It's going to be subject to a regulatory pry. And I heard all these takes, and I had a very kind of institutional lens on Bitcoin, which was it was just this like speculative thing used in the deepest, darkest corners of the web. And so when it reached this 5K, it was just like a round number bias. And I just said, oh, I'm just going to
Mhm.
sell everything but a little bit. And obviously proceeded to miss out on what would have been a 4x from there.
Yeah, I think it might have been hard to see the fervor. I don't know if it was like this in London, but in the US at that time, I know in Los Angeles around Thanksgiving in LA 2017, I would go to bars and I just hear people talking about Bitcoin. You'd overhear it. It was like Thanksgiving dinner conversation. It would come up because it was hitting 20,000. And I think that year I bought my mom some and I think I paid 15. I mean, it was at 15,000. I just bought her $100 worth. And then I moved it from Coinbase to a wallet that I set up for her, and it cost me $30 to move that stupid Bitcoin because the network was so congested. So her $100 soon became $70, but it's given us something to talk about over the years. But yeah, I think that it really just was it was, I don't know, it's not like the gold rush, but it was just, it had captured the zeitgeist at that moment. And I think that everybody thought they were going to get filthy rich. And then, of course, it completely crashed the next year. Did you along that way, like obviously DeFi is a lot different than Bitcoin. What caught your eye there, and how did you mentioned smart contracts? Was there a certain project or the difference in the sort of foundational nature of Ethereum versus Bitcoin that appealed to you?
Yeah, so if I pick up the story there, so Bitcoin went off on this amazing run in 2017. I was still working in the finance industry and continued to do so for the next 2 or 3 years. And obviously, Bitcoin crashed and went into this bear market, and so did Ethereum. I just held what I had and like just always saw it as a kind of whatever asset, right? Really didn't make up much of my portfolio. And then when I quit my job, I still wasn't really actively looking at the space. And a friend mentioned something about Aave. So Aave and Compound were like the first kind of borrowing and lending platforms on Ethereum.
So we're like in DeFi summer or
Yeah,
territory,
so you're
like
approaching
2020 roughly.
yeah, so you're
Yeah.
approaching DeFi summer. This is when Aave was still called, oh, I forget the name now. Anyway, and a friend was like, "Oh, you should check out Aave or Compound." And they had all this ridiculous yield, and I remember just thinking, how can you pay yield in a token which has no value? Like it's just a governance token. And it just baffled me. I was like, but you're paying for a vote. Who cares about governance of a platform? You're not taking any kind of revenue share in the platform. And they were like, no, but you're paid in this token, and the platform, as it grows, there'll be more people that want to have governance over the protocol. And I still was scratching my head. I was like, I don't get the value of governance tokens, but I'll participate and I'll use the platform. So I use these DeFi platforms. And what got me very interested was this idea that they were doing things in a completely permissionless manner. So if you held an asset like ETH, you can put it into an ETH vault and borrow stablecoins against it, right? It's a good way of being maybe like a synthetic borrowing or whatever it might be, synthetic leverage, because you can borrow more USDC and be long more ETH, for example.
Mm.
And that's what really caught my eye, the fact that this was permissionless technology. Anybody could connect their wallet. Doxing myself here, but I'm like British Indian and half my family live in India, and they had access to the same technology as me. And they could participate in it, assuming they could on ramp into MetaMask and into the EVM world.
And
And
coming from the banking world, that's a gatekeeping function, right, of banks. It's like only certain customers or clients of a bank get to do that. And like that they'll take a collateral from you and loan you something else. Like that's not some retail folks that are walking in to B of A getting that kind of offer. But here, it's anyone, like you just said, who can figure out a wallet and figure out MetaMask and swap the coins.
exactly that. And so it was the permissionless nature of smart contracts that really got me excited. There was a lot of hype at the time, like you could issue bonds on the Ethereum network, or you could have insurance contracts from like an Aviva or somewhere like that, which paid out if certain conditions were reached in like an airplane was cancelled or something, immediately the smart contract paid you out. And I saw all these huge inefficiencies which were choking me when I worked in the bank because it was stifling innovation to work in a bank. And then I saw this huge possibility that a smart contract can strip away 90% of middlemen or middlewomen or that middle layer, that marzipan layer of staff. And that's what really got me interested. So I started looking at different DeFi applications, so not just borrowing and lending, but some of the AMMs, the automated market makers like Uniswap, and the way that they were creating like synthetic financial markets where the price automatically adjusted along a bonding curve or along a pricing curve of some sort. That then led to some like more kind of opportunistic farming and mercenary capital, where you'd farm on a particular chain or a particular protocol and then earn more of those tokens and then sell those tokens and move on to the next farm. So you're right, what's colloquially termed DeFi summer, I was participating in that. And all of that kind of combined led me to December 2021, where I was a member of a DAO called Developer DAO,
Okay.
and I connected with some developer friends and we decided to launch a DeFi project. So it was all experimental, following my interest. I guess in some way I was fortunate that COVID happened because it gave me the time to sit and read and learn about a lot of these things. And not having the job and whatever was also obviously liberating on my time as well.
And that was the foundation of Pear Protocol.
No, that was a foundation of something, a subsection of DeFi called farming as a service. At that time, December 2021, there was all this yield to be extracted on chain. So you had
Yeah,
things like,
can you slow it down and let's explain for listeners like what is yield farming and how does that actually work?
absolutely. So yield farming comes in many different forms, but two of the most kind of common are providing liquidity. Let's say somebody wants to trade ETH for USDC. Typically, what you would do is you would go to a centralized exchange like Coinbase. You would take your USDC or your US dollars, convert them to USDC, or convert your US dollars directly and buy ETH. That's been the way for centralized exchanges to operate and trade. The innovation that happened in DeFi, and especially with regards to automated market makers, was this idea that you could become a market maker, which means you could put up into a pool ETH, 50% of your assets in ETH, 50% in USDC, and then other people would participate in that pool. So it was completely balanced initially. And then as every time somebody traded against that pool, so a user came in the front end of Uniswap, swapped, let's say, one USDC for 0.01 ETH, the pool became slightly imbalanced. And you could be the provider of that liquidity. You could provide ETH or USDC or both assets in the pool and earn a percentage of those trading fees. And so yield farming in that way was being an LP, was being a liquidity provider. That's one way of yield farming. Another is just to provide an asset, like on a borrowing and lending platform, you might provide collateral asset like USDC that people can borrow and you get paid a yield to do that. And then you had all these other crazy things like Olympus DAO and their whole concept of protocol owned liquidity and these kind of game theory mechanics of as long as you don't sell and as long as people don't come in, then we can be in this perpetual money printing machine.
And it's interesting, last year in 2022, when we had so many failures in the space, a lot of centralized failures, these sort of decentralized markets like Uniswap and all the others performed pretty well. Like, I don't remember any blowups in that market. And I think it probably got rough. I think there's probably some pretty big liquidity issues if you're trading in some of the altcoins, but for the most part, it was impressive that those decentralized exchanges worked as advertised.
Exactly, especially the borrowing and lending markets. So if you think about, just to simplify your answer, yield farming is finding opportunities to generate interest on chain. And you might be able to do that by putting up different assets on different platforms and earn a percentage of the trading revenue. You're right. One thing that worked particularly well was the borrowing and lending platforms. So let's say users come to Aave. They've decided they're quite optimistic on ETH. They already hold ETH, so they put all their ETH on deposit on Aave. They earn some interest for doing so. They then, on the borrowing side, say, hey, look, my ETH is collateral. I want to borrow USDC. So they borrow, let's say they put $1,000 worth of ETH down as collateral. They're earning interest on that. They might go and borrow 50% LTV. So they might go and borrow 500 USDC.
Mhm.
That 500 USDC, they might do whatever they want, spend it in real life, they might go and buy some more ETH, whatever it might be. Now, as long as the value of the ETH collateral doesn't fall below 500, that position's fine. The minute it does, then they need to run a liquidation, take your ETH collateral and sell it in the market so that the borrower, and you get to keep the 500 you borrowed, and the platformer, whoever's provided that, is not taking a loss. They've taken your ETH from you and they've taken it at a value more than 500. Those liquidations were processed incredibly smoothly. And if I draw a contrast to a bank where they need to liquidate an asset of yours, it can go through an entirely inefficient and often unmeritocratic legal system where other people get access to their capital before others. And you saw that with
Mhm.
FTX. There was like a withdrawal queue, and some people just got preferential treatment depending on where they did their KYC, depending on if they knew somebody on the inside. That didn't happen in DeFi. You got what the smart contract said you were going to get. And if you were going to get liquidated, it was processed smoothly. If you put a withdrawal request, you were just in line depending on when you put that withdrawal request in. And so everything worked fine and it was a great stress test. And you're right, it was all the failures of 2022 were centralized exchange failures or CeFi failures. DeFi was incredibly resilient.
Another aspect of that's really interesting is on the banking side, you might not even know the value of what you're holding and trying to sell, right? Like in the financial crisis, there were tranches of collateralized debt obligations made up of mortgages that God knows where they were coming from. And you're trying to like sell them because you were getting margin calls or whatever it was, whatever the case may be, but nobody could agree on the price. So then that's a whole nother aspect that you get into with traditional finance, where in this case, with the ETH and US dollar coin, you know the pricing any second of the day. So I guess we shouldn't say, I don't mean to say that DeFi doesn't get overly complicated, because it certainly does. But in this case, like everything is just right there out in the open, and I find that really refreshing. And I think a lot of people do as well.
Yeah, what was amazing, right, is when Lehman was going down in the kind of October, September 15th, I think it was 2008, the way that information was being disseminated, and I think I was doing some kind of internship of some sort, is it was being disseminated through media outlets, and then banks didn't know the true extent of their exposure.
Yeah.
Internally, never mind to other banks, they didn't know their own internal exposure. Whereas with DeFi, what you had was real-time analysis. So you had, on Twitter in particular, people identifying wallets, tagging them to individual funds or entities and saying, these are the assets they have. This is what's at risk. If ETH goes to this level, this is how much LTV they have. This is how much bad debt they have. Like, you can see it all on chain. And that was just fascinating to draw a comparison between something that had happened 13, 14 years ago, where everybody was like, what the hell is this? And how much mortgage of this like toxic mortgage debt do I hold?
Right.
Versus people who knew exactly where, in a crowdsourced manner, where the risks were, and it created a lot of opportunity for arbitragers.
Yeah, absolutely. And just one last point on that. Then you add the swaps market on top of that, where like banks literally did not know how much exposure they had to each other because it was such a tangled web, because those are all private and there was no one sorting out, okay, what's my net exposure between Deutsche and Goldman or JP Morgan and Credit Suisse? There was, it would take you weeks to figure that out. And as I remember reporting on at the time, a huge reason that the Fed just decided to come in with TARP and just start throwing money at the global financial system, because it was gonna come down basically. So I get it, but what a fucking mess.
At the heart of DeFi is this idea of collateral, right? Like, you put up some asset, it's worth something, and the other party, whether it's a platform or an individual user, if anything goes wrong, they have a right over that collateral. And you can always ask for more collateral or whatever it might be. In banks, it's incredibly inefficient because you need to have an ISDA CSA legal agreement. You then have an annex to each of those ISDA CSA agreements
Yeah,
with
and these
like
ISDAs can be 800 pages long. They're
be 800
insane.
pages long,
Yeah.
and they can be different for every single entity within every single fund that an entity has. And then you've got to post against individual trades, initial margin and variation margin. And there's emails going back and forth between an army of hundreds of back office staff trying to agree how much they should post. And then T+2 settlement on top of all of that. And in DeFi, what's amazing is the smart contract dictates where collateral flows, and it's almost instantaneous settlement. And people like to say I've got a lot of detractors who are still working TradFi and they think I'm working on Ponzi's and this whole thing is just like one big scam. I say to them, like, the efficiency gains for things like collateral management or OTC dealing, and the fact that things are governed by code and not by humans, and especially not by lawyers, it's incredibly powerful. And if you can't see that yet, I think it's a very tainted lens through which you look at things.
Yeah, agreed. And that's touching on something that I wanted to ask you about, because I've often heard from folks in big banks that the technology that they have is a shit show. Like, they might have 7 different systems that have been patched together from acquisitions, and or maybe something's very old and it's just never been upgraded. And then you bring in like a blockchain based system, like an enterprise based system where, a group of banks in a market could all be connected. And like, that was always seemed to me to make a lot of sense. Like, this would be a very, like you were saying, a way to gain a lot of efficiency, because when these trades are T+2, which means they don't settle for 2 days, you've got to put some of your capital aside until that settles in case something goes wrong. So you can't use that money for anything else. And so that's costing the banks money. If you could make it more instantaneous on an enterprise blockchain system, then you've freed up a lot of capital to do other things with. So what was it more? I'm curious, when you were at the banking side of your career, was the technology bad, or was it more just like you were saying, that the need for people and the need for lawyers, like what, or was it a mix of those things?
Yeah, I think it was. I think it was a mix of things. I think there was a confluence of personal factors. So, like, hitting this age milestone of 30, missed the Web2 fintech boat, and having watched some of the companies I could have joined go into an IPO, it was obviously like a realization that the things that were really growing in the S&P were the tech names, and everything else was a little bit stagnant. There was a lot of observation going on as to what was happening outside of TradFi. And then within traditional finance, there was a lot of inertia to change, because the minute that you start to replace these systems, a lot of people and a lot of jobs are potentially going to go. And
Yeah.
so it's a bit like turkeys voting for Christmas when you kind of go into these meetings about whether this new technology should be implemented.
And you have to get all these fierce competitors to cooperate. That was always a huge battle when I was reporting on this for Bloomberg. Was like, Why would usually these guys are at each other's throats all day long trying to get the better trade or to woo a customer to come to them. And now all of a sudden it's like, no, we have to cooperate and we have to trust each other in a system where it's possible that I might show you something I am not supposed to show. Right? So there was a
Mm.
lot of trepidation about that as well, I think.
Yeah, I think you're exactly right. The incentives are not aligned for people to take risk,
Yeah.
and that's a good thing
You
because
know,
obviously the regulators wanted that, not to take financial risk and not to take especially risk which leads to like contagion and moral hazard. But what it's also done is created like a mindset of not taking any risk in terms of innovation as well amongst a
correct.
subset
Yeah.
of
And to me, this is all fine because, like we are talking about, DeFi is happening. It's an alternative. It's being done now. And it doesn't matter that the banks don't like this or not. They don't really matter to the conversation because people are making this happen and they have been making it happen for many years now. And so I always try to, people like the naysayers you were mentioning, they all seem to think that it has to be all or nothing. And that's just the wrong way of thinking about this. The most of what we're talking about here is an alternative to what already exists. And I think if you can't see that, it's like the dollar's not going to go away. Wall Street's not going away. This is all an alternative to those systems for people who want an alternative. And it gets a little tiresome to have to talk to people who can't see that because it's staring them in the face. But let's go. Okay, so now we're ready. You had a kind of a proto company before Pear Protocol, but was there a pain point or something or that you guys were noticing, or what was the problem you were trying to solve that led to Pear?
There was so December 2021, we decided to launch a token mechanism where investors swap their ETH for our token, and then we would actively farm on their behalf. So this concept of yield farming, the way I described it by doing like providing liquidity on Uniswap, by participating in a borrowing and lending market, by maybe even bridging over to another chain like Avalanche and playing some of these games and earning yield. It's a lot of cumbersome work, right? It's a lot of clicking buttons. It's a lot of hopping between different protocols, and
Is that very different than just a hedge fund, but in the digital asset space, you've got,
exactly
you're doing, yeah, that's what a hedge fund does.
exactly that. So this idea that there was yield to be captured, but you had to be active in what you're doing and fairly fast fingers at the same time, I saw the inefficiency. And so we decided to launch a project. The subsection that we created within DeFi was called Farming as a Service. And our whole business premise was to generate yield for anybody who bought our token. And we would do that by taking their ETH, farming across different chains, and then passing back the yield in ETH terms. So the whole point was that they would earn these rewards above and beyond what the value of their initial ETH was.
Sure, taking a little cut for yourselves.
Of
Yeah,
course. So that was our business model, and it was incredibly successful because the opportunities to yield farm were incredible. So the baseline, and now I'm going to bring in a villain, but like the benchmark yield in a lot of people's minds was 20% per annum because they were going to Do
it's
Kwon's
crazy.
Terra blockchain. They were going on Anchor Protocol, and they were putting this UST, which was great marketing to call it US Treasuries, like the same three letters as US Treasuries, UST, US Terra, and making 20% yield. That was the baseline expectation in 2021, 2022.
Yeah,
Most of the incentivized farms on Phantom or Avalanche, etc., were paying you something in the magnitude between 100% and 1,000% APR or APY rather, especially if you reinvested the tokens or sold and reinvested the tokens. So for us, generating yield wasn't that difficult because there was plentiful opportunities. And then the summer came,
but the risk
and
management that's the whole game there, right? Because you do not want to get caught when everything collapses.
correct. You don't want to be left holding the baby. And so it's some call it risk management, some call it mercenary capital. Like the idea is you've just got to diversify your risk and go from farm to farm, opportunity to opportunity, and hopefully not get hacked along the way, or one of the platforms doesn't get hacked along the way. And that was our value add for investors. And they were really happy because we were making these yields for them. And then the summer came and Three Arrows Capital collapsed. Luna collapsed. The entire edifice and idea of 20% being the benchmark yield obviously got torn apart and shown to be what it was, which was like a kind of naked Ponzi, if you will. And the yields collapsed across the board. So on-chain activity died down, lots of liquidations happened, prices were much lower, total volume captured in DeFi was decimated. Not quite literally decimated, but did go down like more than 50%. And yield just collapsed. And so for us, we were like, we need to generate return for these investors. It might not be 100% plus APY. What can we do? And so we started scratching our heads. I dipped into my old expertise, which was in volatility. So I was selling options, maybe doing some volatility arbitrage between different platforms, but that wasn't scalable, at least given the maturity of the options market. And then we decided upon pairs trading. Dusted off a lot of TradFi textbooks from the 90s and this idea that you can be long one asset and short another asset.
And
In
just
a
to
narrative,
jump in there, if you're long, you're hoping that the price goes up, and if you're short, you're hoping the price goes down. And if those occur, then you're making money on each side of the trade.
exactly. So a good example over the past few years, you may have wanted to be long Apple and short Meta. And even though Meta or Facebook has gone up in value, Apple has gone up way more over a period of 5 years or 10 years. And the
And
idea,
if you were doing that trade and like on the Wall Street side, do you have to go to a bank and get them to do it for you? That's a tough trade to do on a public exchange, right?
correct, because of the shorting, right? So
So
how
that's very dangerous. Like you can lose a hell of a lot of money if you're short and it goes the wrong way against you.
especially if let's think about it from each component. If you're an investor and you have a view, you don't care if the Nasdaq is going to go up or down, but you do think that Apple is fundamentally undervalued compared to Facebook or Meta, especially with all the like VR hype and everything going on. So the trade is quite clear. You want to be long Apple, you want to be short Meta. Now, being long Apple is easy. You can go to any brokerage and you can be long Apple
Yeah, you
stock.
just buy shares.
You can just
Yeah.
buy it. But how do you sell something you don't have? You need access to a borrow market. You need to be able to borrow those Meta shares from somebody, sell them in the open market at today's price, let's say $200, and then in 3 months from now, 6 months from now, somebody comes back and says, "Hey, I want my Meta shares back." You buy them at a much cheaper price in the market. Let's say they're now at $30, and you buy back the same number of shares that you initially sold at a much cheaper total price, and you pocketed the difference, right?
Yeah.
That's the idea of shorting. So you do need a bank, or you need some kind of
Yeah.
bank or platform that allows you to borrow.
And you're an accredited investor. You have to be sophisticated. All sorts of like tests are done. So this is not a retail thing for the most part for people.
For the most part, no. And for the most
Yeah.
part, it's hedge funds dealing with banks
Yeah.
that take these kind of trades on.
But again, to take this into DeFi, everyone has the opportunity to have access to this sort of pairs trading.
Everybody has access because the infrastructure has already been built in a permissionless way. So the idea of decentralized exchanges is that you have access to the same trading tools that are otherwise reserved for accredited investors or for hedge funds or these like big institutions. Within DeFi, like nobody cares who you are. You just go onto a decentralized exchange, load it up with some cash, and you can trade whatever assets you like, long and short.
Yeah, absolutely. How much longer after December 2021 did Pear Protocol come into focus?
So what was happening was summer of 2022 was happening. The yields had collapsed, and we couldn't or didn't have the stomach to do much yield farming because there was just not much opportunity. And then once you factor in the smart contract risk and the fact that smart contracts can be compromised and all the assets can be drained from a protocol, we started doing more and more of this pairs trading. Now, the example I just gave you in TradFi is a narrative trade. You believe that Apple is going to outperform Meta. Crypto trades off narratives all the time. A common narrative is that Ethereum will one day flip in Bitcoin in terms of market cap. So Ethereum to outperform Bitcoin. Other narratives come about all the time, like this layer one, whether it's Solana or Avalanche or Phantom, will outperform a different layer one, let's say Ethereum, right? There's an
Mhm.
Ethereum killer. Or there's other narratives that come about around gaming or around
Pepe or memes, meme
me,
coins, right?
exactly.
Yeah.
And for a small period of time, there will be a narrative that will outperform the broader market. And so for us in the summer, what we were doing, in lieu of there being many other yield farming opportunities, was doubling down on pair trades. So we were being long Ethereum versus short Ethereum Classic, the kind of old proof of work network.
Yeah.
We were being long Atom and short Solana because of everything that was going on with FTX and the rumors surrounding SBF, but long like a competitor layer one. And what we realized is when we pair trade, we're currently going to Binance or we're going to some kind of decentralized exchange. And even though we have the ability to long one asset and short another asset, once you start to do that on a systematic basis, build a portfolio of longs and build a portfolio of shorts, there's a whole host of problems that we encountered. We had to post margin against each individual long, post margin against each individual short. We had to work out the P&L manually on an atom sol pair. From a visual perspective, there was just tens of lines of positions at some point. And also from talking to people, we were like, oh, you want to pairs trade, but there's nowhere for you to do it. And so that was the genesis of Pear Protocol, was to build a UI and a UX dedicated to narrative trading. So if a narrative forms like Pepe, then you could be long Pepe and short Bitcoin.
And if I'm doing a lot of different long shorts on Pair Protocol, are you, because I'm all at the same place, are you netting that down for me so that I know, okay, here's your sort of like net position encompassing all of the things you're doing?
So it's done on a pair by pair basis. So if you're long ETH and short Bitcoin, there'll be a P&L attached to that pair. If you are long Lido and short Rocket Pool, there'll be a P&L attached to that pair.
Okay.
So what we're doing is, rather than you have two trades for each pair trade, you have one. And that one trade is actually tokenized as an NFT. So it's like a unique innovation, but we're tokenizing your net trading position as an ERC-721 as an NFT, so that it's fully composable. You can now move your trading position across different wallets. You could take it to a borrowing and lending platform and borrow against your trading position, bringing about capital efficiency.
So can we dive into that a little more? Because that's
Sure.
fascinating, but I don't quite understand what you mean by my position is now tokenized as an NFT.
For
Is
sure.
the NFT, how is it, an XNFT with a smart contract inside of it, or?
So right now, let's say you have a view that ETH is going to outperform Bitcoin, but broader than that, you don't know whether crypto is going to go up or down. That's a great kind of market under which to pairs trade. To do that kind of pair trade, to be long ETH and short Bitcoin at the same time, you'd have to go to somewhere like Binance, open a long and open a short separately, right? You're paying funding on the long, you're paying funding on the short, if you're using perps, and then you're working out your manual P&L. On Pair Protocol, you select the asset you want to be long, select the asset you want to be short, use some kind of stablecoin as your collateral asset, slide up your leverage if you wish to use it, and click open position. Now, when you click open position, what we're doing is creating one net trading position, which has one P&L, and it's long ETH BTC at whatever the spread is at the time. The NFT itself is just a on-chain image rendering of metadata that's on-chain. So what I mean by that is the NFT is simply like a visual representation of your P&L, but it has economic value. The value of your NFT will change in a dynamic manner based on the metadata attached to it.
So it's somewhat like or it is an ownership claim on that pair trade.
Correct. Yeah.
Okay. All right.
Which
That
can be
makes sense.
broken down and then you can claim the USDC equivalent.
Okay. What are the risks inherent in here? I know leverage, anytime leverage comes into the equation, it can get messy. But as we've been talking about, I would assume your protocol has these measures where if the collateral is blown out, then the trade is liquidated. Is that what's going on, or what is maybe a liquidity crunch on the platform one of your major concerns, or where are the risks in this?
So liquidations are like running efficient liquidations is obviously our problem, because otherwise the platform ends up holding the baby, if you will, if we don't process the liquidation effectively. However, pairs trading, if you think about being long ETH and short BTC, moves within a fairly tight band, right? So ETH goes up 5% and Bitcoin goes up 4%. then you've made 1% that day. So you've lost 4% on Bitcoin, but you've made 5% on ETH. And vice versa. If it goes the other way and ETH is down, let's say 10% and Bitcoin's only down 9%, you've lost 1% there because you've made your 9% on Bitcoin but lost 10% on ETH. Very rarely do the two diverge. So very rarely are you going to have a day where ETH is down 10% and Bitcoin's up 10%. So the scenarios under which you lose on both legs is very rare. The bands within which a pair trade move is usually between 0 and 1% a day. Obviously, as you slide up your leverage, those gains and losses become somewhat magnified. But that's not the real risk. The risk to us is that we're trying to do something brand new. And in the process of doing that, obviously there's lots of testing involved. What we're finding in the process of building Pear Protocol, and we're in private beta at the moment, is there's a lot of these kind of edge cases that we need to think about where the collateral flows, how the liquidations are run, if only one of the legs is liquidated and not the other, any kind of time delays in burning the NFT image, like things that are really on the precipice of innovation, which we're encountering as roadblocks, but it's great to do because that's why we're in it, right? Not just to make money, but to create modular technology that other people can build on top of.
Yeah. Okay. Very cool. And then we talked a little bit about this before, but Huff is not your real name, and you have concerns about some of the regulatory environment and some other things. I was wondering if you could just talk about that. And because, as listeners probably know, there's quite a few teams out there in Web3 that are pseudonymous and they're not using their real names for various reasons. And I'd love to hear what your thinking was behind that and why you're not putting your real name out there at this point.
Yeah, my real name and my identity is out there in the sense that we're VC backed, right? So whenever we spoke to a venture cap firm or whenever we spoke to a market maker, we put our cameras on, we told our names, they asked for our LinkedIn's and our backgrounds, etc. We're happy to do that. Even when I'm at conferences, I have my real name on my badge. If I'm on a panel or I'm a speaker, I have my real name. The main reason is from like a public domain, so especially on Twitter going out into the world as Huff is a lot more comfortable than going out with my like first name and last name. And it's because of two things, you're right. The first is regulatory. We're in a grey area, or an evolving area rather, a very fluid area of regulatory developments when it comes to DeFi. Now, I'm in the UK, so I have a UK nexus, and the UK regulator is a lot more friendly than they are in the US. But you're right, a lot of teams, especially if they have a US nexus, will decide to be anonymous because they're quite clearly in the line of sight of the SEC and other regulatory bodies. I think for me, as somebody who sits in the UK and potentially is part of the whole MiCA legislation that's coming in, until a lot of that is clearer, being the co-founder of of a decentralized exchange is just much more comfortable to be Huff and have my avatar there. Until I've got full regulatory certainty on how this should be taxed, how geo blocking works of our users, and so many other expectations which have not been formally written down. And then the second is crypto Twitter in particular, which is where a lot of the activity goes on in terms of knowledge and research and sharing of views, is quite a toxic place. And when people find out who you are, they can use that to meme your identity once they know that you're responsible for treasury, which can make anywhere between 50K a day in fees. Once they know that you're previously managing like a fairly big portfolio on behalf of DAOs, you just put a dot on your head, which I don't necessarily need to do. And it's not a key requirement. There's not people on Twitter demanding to see my face or my full
Right.
name. In the public domain, I'd rather be Huff privately and with like professional individuals like yourself, Matt. I'm happy to go by my name.
Are you paying attention to what's happening in the United States on the regulatory front, or is that just, are you concentrating on the UK? Do you have any perspective on, obviously, as you've said, and as it's pretty clear to anybody who's paying attention, the UK is much more friendly right now to decentralized applications. The US seems on a, I don't know what to call it. They just want to shut down as much of this as they can, and they're choking the banks and doing things we really can't get around. But how is that from your point of view?
I'm following it very closely because we have a legal team, right, that support us, and everything in our setup has been done in conjunction with them. So they've set up the kind of DAO setup with the Cayman Foundation. They've set up our token issuance vehicle, which is offshore. We've got the DevCo, which is a UK development company. And then they've given us wording and guidance to put with regards to US investors using this, not being able to use this, etc. What's particularly of interest to me with regards to the US is staking and the way that they either perceive ETH as a security and whether they see ETH yield in the form of proof of stake payments and yield that's being generated as a interest bearing
Instrument.
instrument. Exactly.
Right.
And so that is an interesting development because obviously it has potentially global ramifications. My perspective on what's happening in the US is that they were caught with their pants down with regards to FTX, and there's like this overreach and overreaction to
Amen to
appeal.
that. I don't think it was even their pants down. They had their hands in his pocket.
Exactly that.
And a lot of them look really bad. So they're overreacting in the other way now, in my opinion.
Yeah, and I think there's certain individuals, right, at the SEC or whatever, they've created a persona for themselves and they feel emboldened every time somebody comes from them. It gives them a sense of purpose in the latter years of their career to play like a villain arc. And there are people in the world who just enjoy it. They just enjoy that villain arc in the name of doing good in the world and creating a name for themselves. And they don't want to be a nobody that goes down as like another aging regulator who disappeared into the abyss. They want to create a name for themselves and they have a small opportunity, bless them, because they're creating an opportunity to create anti-fragility and create other innovation hubs in the world.
Yeah. And I'll say it. It's Gary Gensler, but you don't have to say it. This has been fascinating. I know the protocol isn't yet live. You said you're in private beta. What's the timing for a launch?
So, like I said, we are building pretty experimental and new and innovative tech. This idea of being able to tokenize a trading position and then have that trading position, the jargon is composable across DeFi, is obviously like something we're building and excited about building. The other piece that we're doing, which is really cool, is we are tapping into off-chain liquidity, so integrating directly with market makers so that rather than go through an order book like DYDX, Pear Protocol directly faces market makers, and that'll be a huge game changer in terms of being able to scale the number of assets tradable on chain. The fact that we're doing those two things, so tokenizing as NFTs and then integrating with off chain liquidity via market makers, means that private beta is probably going to be ongoing throughout May and June. We'll then get the audits done and look to do a full public launch. We're aiming for August with a token launch of the Pear token in September. So those are some of the key dates that we are working towards.
Okay. And that's why you're concerned about staking, right? Because you would come into the protocol and buy pair token with whatever, right? And then that's how you use it on the platform. Am I correct with that?
Correct. So the Pear Protocol is going to generate trading fees. Our estimate on trading fees is anywhere between 50K and 100K a day. So quite meaningful fees. And because we're building a decentralized project, the intention would be to pay those fees back to all token holders so that everybody has a say in how the protocol is governed and run. I think the kind of general thinking, and you'll know this, Matt, in DeFi is you build stuff and then other people run it over time and you just step back. And so, yeah, we're quite keen on staking developments because there is currently in the pipeline, it's scheduled for us to have a staking mechanism for the pair token.
Yeah. Okay. Excellent. Tell people how they can get involved or find out more or follow you guys on your roadmap.
Perfect. So I think to follow me, it's on Twitter at HUFHAUS, so HuffHouse9. You should be able to find me as the co-founder of Pear Protocol. To follow Pear Protocol, again, Twitter is the best place for Pear_protocol. We do utilize memes quite often, but we are quite a serious project. And then the Pear Protocol Twitter page will take you to our Discord and have a Discord link, and that's where you'll find at least a handful of the core team of 10 people there available daily to answer any questions and share any kind of more details about when we're launching and when the token's coming as well.
I did notice the Pepe meme is quite strong on your Pair Protocol Twitter page. So
Yes, we are fully.
is it the green, the pear and the green just goes together?
it all kind of works.
All right, that's a great place to leave it. Huff, thank you so much. This has been fascinating, and thanks for sharing all your insights and your backstory with us. And best of luck with the public launch.
Perfect. Thank you so much, Matt.
That's it for this episode. Thanks for joining us, and don't forget to rate and follow this show on Apple, Spotify, and Amazon Music. Decent People is a production of Decential Media. It is produced by Matt Bogart, with music by Brian Duncan and Kareem Imes.